Good afternoon and good evening, everyone. It's an honor for us to host Jay Pelosky again at On Research. We have a lot to talk about today, and especially in a day like today, where Brazil, Brazil's markets having, a difficult day, it shows our purpose and the merits of international diversification. So, we are a global house. We're proud to have, Jay on our platform. And we have a lot of ground to talk about and to cover today. So, before I hand over to Jay, I'd like to give him the chance to, do his victory lap and talk about, his, U.S. Treasury 10-year rate call. He's been saying this for at least, 3 months that the market was, dead wrong with 1.3, 1.4 forecasts. And here we are now, and how that means, kryptonite for the tech sector. So I'll let Jay start with this, and then, of course, I'll have questions and also questions from the audience.
Great, thanks, Roberto, and hello, everyone. And indeed, it's been a pretty active day and following a very active week. I mean, I think last week, as I mentioned in my musings, was very important. It really signified, in my mind anyway, the end of U.S. big tech-led equity dominance. The U.S. has been the best market in the world for over a decade, led by technology. I think we are seeing the end of that. We also saw, I believe last week, the beginning of a bear market in U.S. Treasuries, which hasn't really been seen for 40 years. And we also witnessed, with the passage of the Biden rescue plan, I believe, a birth of a new political paradigm in the United States, which is also something that we haven't seen for 40 years. So it's no surprise that markets are somewhat chaotic and somewhat unsettled, because we are going through major regime shifts in the markets, in politics, in things like climate, in the thematics that we've talked about in the past. So it is good to see that some of those perspectives that I've been writing about for months have been coming to pass. I noted in the fall that the biggest single consensus mistake that I saw in all the sell-side outlooks for 2021 was the U.S. Treasury call. The vast majority of people had the 10-year ending 2021 at 1.2%. And I am in writing since November saying I expected 1.75 to 2%. I also highlighted at the same time how vaccinations and rising rates were kryptonite for big tech. Obviously, the vaccinations kind of end the work from home theme. And if you go back and look, many of those stocks peaked in the fall, in September and October. And now with rising rates, you hit directly at the valuation of these long duration growth stocks. So it's no surprise that we're having what I called in my 2021 outlook, written in November, the great rotation, and highlighting this rotation away from tech, away from growth, away from the US to the non-US markets, primarily developed, primarily Europe, Japan, parts of EM, as well as the move to cyclicals, value, small caps, etc. And within that, there's also the thematic approach, which I've been writing about more recently, including in my monthly last month, Investing Thematically, where I argue that the alpha opportunity is going to be in the thematics as COVID speed, the model that we witnessed with COVID, where we put global intellectual and financial capital to work on a single problem, resulting in a vaccine, multiple effective vaccines in 1/10 of the time it has taken historically. That model is a new paradigm for the global investment landscape, and is going to be brought to bear in terms of issues like climate, like cyber. If you look at Bloomberg and other things today, it's talking about a global cyber attack. These are issues that are not going to be addressed at the single country level or the global level. They're going to be addressed at the regional level. And this is where I think my tripolar world framework and global risk nexus really allows me to have a differentiated view towards the markets. And I just note that in terms of markets, everything begins now with health. And it's clear that in the US, the vaccination program is accelerating rapidly. We had a day over the weekend where 2.9 million doses were put to use. We're averaging 2.2 million over the last 7 days. And just to give you an illustration, Roberto, 2.2 million is roughly 1% of the adult population of the United States being vaccinated every day. So we are moving aggressively here, and that's a good thing. The issue in the US is no longer vaccine supply, it's demand for vaccines. And what we're seeing is that demand, that desire to get vaccinated is increasing rapidly. And so here in New York City, we have Yankee Stadium, which some of you may have attended a game at one time or another. Yankee Stadium is now a mass vaccination site. Same thing in my home state of Massachusetts, where Gillette Stadium is a mass vaccination site. My mother got her vaccination shot there just last week. So health, things are moving in the right direction. The rescue plan is a sign of a more aggressive, go big, go fast Biden government. And this is going to have implications, obviously, for growth, for inflation, for rates, for earnings, and obviously for financial markets.
No, this is great. And before we actually move on to treasuries and inflation, the price action there, you were the most optimistic, and of course, called this before, but talking about the Biden plan, approved by the Senate last Friday. Number one, was it faster than even you had expected? And if you have, I don't know if there have been any details that you can share with us. Where is this going, and what is this going to address? In particular, looking at areas and also how it's going to be spent.
Well, I think what's interesting is that the impeachment vote, the second impeachment vote against President Trump, I think set the stage for this, in that there was very little in the way of Republican support for that impeachment. And that sent a signal to the Democrats that it's not really worth trying to water down or delay their own plan in the hope of getting Republican support. And so that led to a plan being roughly exactly the size that was proposed. We've been talking about $1.9 trillion for several months, and that's pretty much exactly what has been passed. And most of the issues in terms of within the details are also as expected. And it was done via reconciliation, i.e. using the Democrats' single vote majority in the Senate to pass it. And so you really go back and look actually to Georgia, into the Senate races, where you had two Democrats win in Georgia for the first time, maybe forever, but certainly first time in many, many years. And that led to Democrats having the majority in the Senate, House and Senate majority. You have a number of, virtually all the Biden economics team worked in the Obama administration, and they saw the negative political fallout from going too small in the stimulus after the financial crisis of 2008, 2009. So I can't emphasize enough to the audience in Brazil the important political pivot that we are undergoing in the United States. We're going from 40 years of government is the problem. We want to shrink government. Reagan's famous 9 words in the English language, I'm from the government and I'm here to help. that has been turned completely on its head, and you now have a situation where people are desperate for government support. This rescue plan is one of the most popular pieces of legislation in recent history, has a 77% approval rating, even majority approval within the people who declare themselves to pollsters to be Republican voters. And so it's clear that the Biden team understands that a victory over COVID, coupled with continued support on the spending side, is going to lead to a better economic and political outcome, something you and I have talked about several times already in our few conversations to date. And I think this is symbolic. So we're going to have, after the rescue plan, the next is going to be a climate and infrastructure plan. So I think we have to get used to a much more robust, aggressive U.S. government that understands it has big challenges: COVID, unemployment, climate, equality, and it has an opportunity to spend at a time when money is as cheap as it's ever been. And so, okay, we're not talking about 1% 10-year, we're talking about a 1.5, 1.6% 10-year. But I'll just remind you, in 2008, the 10-year was at 6%. 6.
Yeah.
So, we're talking at a very, very different level. So to me, this is a good thing, but the trick for investors is to understand that it doesn't necessarily mean a great stock market for the U.S., because it does mean that we are in a bear market for U.S. Treasuries. This is why the Treasury move is not a short-term move. It is a recognition that we're going into a different political regime. And so rates are highly unlikely to go back under 1% in the 10-year. I continue to think we'll end the year closer to 2%, which is now, by the way, increasingly the consensus, right? The same people who told us 3 months ago it was going to be 1.2 are now telling us it's going to be 1.9 or 2%. I think they're going to be right, but it's important for people to understand that it is a bear market in U.S. Treasuries, and that is a negative for big cap tech. And that has been the leadership, and that's the rotation. So there's a rotation away from the U.S. geographically, and within the U.S. away from big cap tech towards the cyclical and value. And I'll just note, and then I'll stop, that Morgan Stanley this weekend reported that the ownership of energy and financials in the U.S. is in the bottom 10% of the last decade. So let's think about that for a second. The ownership of energy and financials in the U.S., even after this move, is in the bottom 10% of the last decade. In other words, much more to go. It's not going to be a straight line, much as the Treasury sell-off is not going to be a straight line, much as the NASDAQ sell-off is not going to be a straight line. But the amount of people who can continue to reduce technology and add to energy and financials is significant. And so I think it's important for people, as we go through these days where things are moving aggressively, to step back and have a view of where we're going and where we are. And we're still very, very early in the transition away from the U.S., away from growth, to non-U.S. cyclical and value. I'll give you another illustration on the other side. J.P. Morgan reported this weekend that the European reopening trade, which includes things like the airlines, and you and I have talked about jets in the United States, up 3% today. The airlines and other reopening trades in Europe are still very, very cheap relative to where they traditionally are on a price to book value. And when you see Europe moving from just manufacturing PMIs to the service sector starting to get back into health in Europe, which I do think will happen, that is going to support that continued reopening value cyclical segment of European equities, which is something that I continue to favor. So there's a lot going on, but we have a framework, the tripolar world, the global risk nexus. We have a good understanding of where we are in this process, and we have data points from people like Morgan Stanley and JP Morgan and others that suggest that we're still early in this process. The trick, obviously, when things are moving 3, 5, 7, 10% a day, is to be very careful in your entry and exit, because otherwise you're going to get completely chopped up in this type of an environment.
Yeah, no, that's those are great points. And just to summarize, and I think you pointed very well about the Biden administration. So the two things that led to the speedy approval of the fiscal plan was that, number one, they learned from what the Republicans have done in the Trump second impeachment vote, and also what happened during the Obama administration. When they were simply trying to block everything that he was doing. So they basically realized that there was no reason, no point wasting time, trying to, tone the plan down. So they just went, full throttle. So that's and now moving on. I think to you talked about the markets can be choppy and everything. Do you suggest any kind of trading or profit taking in the U.S. Treasury? I mean, you think there could be a rally towards 150? And I guess the second point is, I mean, why isn't the market listening to the Fed? Because they're basically telling us what they're going to do. We talked about asymmetric inflation targeting and these things last time. So starting from this and commenting a bit, on the reaction to Powell's speech last week. Of course, it was dovish, but the market wanted more. So
let me talk first to the idea of where the Treasury market is, and then if I don't remember, you can remind me to talk about the market reaction to that other Jay Powell. So I think you're spot on, Roberto, with the idea that maybe the next move in the Treasury market is for a rally. I mentioned it in my musings and laid out a couple reasons as to why that might be. One is that there's significant resistance at current levels, 1.5, 1.6. Two, you've seen that a $1.9 trillion rescue plan coupled with $70 oil after the attack on the Saudi facilities was not enough to force the market through the resistance. And we know enough about trading to know that that usually signals we're going to start to go in the other direction. And there's a couple of other reasons to support that. One is the record short position in U.S. Treasury futures, absolutely off the charts, by far the biggest short position in the last 20 years, currently already in place. In addition, you have the hedged yields for non-U.S. buyers, think about the Japanese and others in particular, are very attractive at current levels. In addition, you have the auctions upcoming this week in the next couple of days, Wednesday and Thursday, auctions of the 10-year and 30-year. These are going to be very important because one of the things that led us to last week's kind of breakdown of the Treasury market was a very disappointing 7-year auction where demand was not as robust as people were expecting. It was still 2 times bid to cover, but it was considered a poor auction. So we have a couple of things to watch here in the near term. We have the fact that a day like today, you weren't able to get any push through the levels. That's important. You have the auctions Wednesday and Thursday. They're important. You have the Fed meeting next week. That's going to be important, though I don't expect any Fed action. And then you're going to have another big jobs number in March. And that's now 3 weeks away. But just to give the audience a bit of a heads up, people are starting to talk about a 1 million new jobs in March as we reopen in the service sector economy. But keep in mind that we are 10 million jobs short of where we were pre-COVID. So even though the million sounds like a huge number, it is still far from where we were a year ago. And I think that's a really important point. So my own view is that we are closer to a rally in the 10-year than we are anything else. If you look at TLT, for example, the 20 to 30-year ETF for the Treasury market, it's pretty deeply oversold. By the same token, I would just point out that energy, XLE, is now pretty overbought. It has a 14-day RSI of 75. So you have to be very careful. The markets are very one way. It's all buyers or all sellers. Things get discounted very, very quickly. So you have to kind of try and, the old saying, skate to where the puck is going to be as opposed to where the puck is today. And I think that's important for the audience to try and think about. You don't necessarily want to be buying XLE right here. You don't really want to be selling TLT right here. You want to try and have the fortitude and the patience and the discipline to let the market come to you a little bit and act accordingly. And we can get into that a little bit more down the road, but I think I'll leave that there for the moment and then talk about Jay Powell. I mean, I agree completely, Roberto. It's amazing to me that all you hear about in the markets over the last months has been, how the markets are not free, that they're controlled by the Fed in particular. And then last week, when the Fed doesn't control the market the way people want them to, it's kind of like my teenage kid. I mean, no matter what you do as a parent, they're not happy. And so to me, I think the Fed has been extremely clear. The Fed wants inflation. You and I wrote our piece a couple weeks ago saying higher rates are a good thing. And I continue to think higher rates are a good thing. Higher rates suggest vaccinations are working. They suggest that the economy is going to reopen. They suggest that economic activity is going to be robust. They suggest that earnings are going to be good. They suggest that the summer and the fall are going to be a much better time than they were last summer and fall. How is any of that bad? Now, I understand, of course, that in the very near term, the markets move super aggressively and you have a 40 basis point swing in the matter of a couple of weeks. That's going to be somewhat difficult for the markets to digest. But by the same token, I don't think any of us would want to have the opposite: lower interest rates, failed vaccinations, renewed lockdowns, deflation, not inflation. Nobody wants that. So to me, it's I'm struggling to fully. I get the kind of the dynamics of the fixed income market and the amount of money that's in risk parity and 60-40 that has to de-lever when you have aggressive moves like this. That part I understand to a certain extent. But I do think that the Fed has been very clear. We're going to have above target inflation, asymmetric inflation targeting, AIT. We're going to keep the short end pinned. We're going to let the long end move. We're going to have a steeper yield curve. And by the way, another reason to think we may be close to the end of this move is that the yield curve steepness today is roughly akin to where it was at the end of the 2013 taper tantrum. So a lot of people talk about the taper tantrum. We've already had it in terms of the spread in the yield curve. And so to me, I struggle to understand how people want free markets. Well, the Fed letting the long end go from 0.95 to 1.6 is a free market, and it reflects good things. Real rates are still negative. There's no real sign of any kind of credit damage. Credit spreads are not blowing out. So those are the things to watch if you wanted to see long rates kind of impeding economic activity. I think we're far from it. We are going to have transitory inflation spike because of the mechanical falling out of the negative numbers a year ago for the next couple of months. But keep your eye on the core PCE, which is the Fed's preferred number. It's much more stable than the headline inflation number. And even if that rises above the 2% target, I think the Fed is going to be okay with that. So naturally, I think the Fed is hoping that the market has the maturity to realize how things are playing out and to be happy that a 10-year is at 1.5, 1.6. It's much better given where we're going than if it stayed at 1.9. I think part of the reaction was because so many people were under this impression that everything was controlled. And so they didn't believe, even though they knew everybody had US GDP at 5-6% in their 2021 outlook, but still had a 10-year at 1.2. It didn't make any sense other than thinking that the Fed was going to control it. The Fed is now saying we're not going to control it. And so people were freaked. I mean, to me, it's a little bit surprising, but markets move, as we talked about, very quickly. Their markets today, I think, probably because much of the day-to-day is algorithmic and quantitatively driven robotic selling or buying, that you have moves like discount things immediately. And that's why, as I said, you've got to be careful about selling treasuries here, careful about buying energy here. The move has already happened. Now you have to think about what's going to come next.
That's those are great points, and that's a great summary. Talking about one thing which is moving wildly is technology. If I'm not wrong, today, the Nasdaq is already at a correction. According to the way most people define it.
Yeah.
And as you pointed well, I mean, not all tech companies are the same story, have the same driver. So can you tell a little bit more, and elaborate on how you define the disruptors and the dominators, and of course, where you see most value? I mean, it's clear to us that the dominators have been the ones that benefited from the work from home trade. But how do you see this space right now?
Yeah, I think it's a little chaotic, to be honest. I've been surprised, and not positively, by how the several of the thematics, particularly around clean energy, have been caught up with the sell-off and the big tech long duration growth names. I mean, to me, I guess I can see kind of that the clean energy is a long theme and therefore valued very, very highly. But I struggle to think that people are valuing those companies, those innovative companies, at the same in the same fashion as they're valuing, cash cows like Google, Microsoft, Apple, Amazon, etc., the FANGs. So to me, the good news is that I don't expect the NASDAQ to crash because this is not 1999, 2000. These are companies that are throwing off tremendous amounts of cash, have hugely well-established businesses, and are going to continue to be successful. I think what I expect, at least, is for them to be okay absolute performers, but relative to the cyclical and value segments, underperformers. And the same goes for the US versus the rest of the world. And that's happening. ACWI ex-US is outperforming the US by 300 plus basis points year to date because it doesn't have those big cap tech names in it. And so it's actually kind of the best environment for non-US to outperform. Because if the US cracks and goes down big, everything goes down big. That's a given. But if tech corrects, and as we've seen and play out in real time here in the last week or two, the S&P itself is fine because you have energy, you have financials, you have materials, you have small caps all doing well. S&P itself is down, 3% or so. I think the risk is if you do see the 10-year blow out again from 1.5% to 2%, then I think the risk is that you have the cyclical and value stocks get hit because, as I say, they're overbought, or part of them are overbought right now. So that would be a natural place for people to then look to take profits. And that's why I say you want to be careful. You hopefully already own XLE and XLF, but if you don't, I don't think you necessarily want to be stepping in to buy right here. And again, that's the discipline. You have to be disciplined. So when I look at your big cap tech, the FANGs, the domination, what I wrote about Down with Domination in my the title of my musings, that's what I was talking about. They're going to be relative underperformers, I think, for a considerable period of time. They're not going to crash. That allows the non-US markets to outperform, and that allows the cyclical value rotation to develop. The innovators, the thematic alpha generating opportunity set is also not like 2000. And the reason is because climate in particular, but also cyber, and I think the kind of the emerging nexus between fintech, crypto, and traditional banking, those are the three areas I'm focusing on now, plus infrastructure in the US, that the climate thrust means that tremendous amounts of money are going to be spent on dealing with the climate in the next 3 to 5 years. That did not happen in 2000. There was no huge global government-led spending package process to support tech in 2000 as there is to support innovative clean energy tech in 2021. And so that's the very significant difference that I don't see many people talking about. And that's why I say the COVID model, that speed model, breaking out from health, again, got us multiple effective vaccines in 1/10 of the normal time. I think we're going to see the same thing in the next couple of years in the clean energy space, in the climate area, as well as in cyber. And again, as I mentioned, in that fintech space. And then the infrastructure theme, which is something in my model portfolio, which I updated last week, I added to significantly. That infrastructure theme is a very robust one, I believe, in the United States. And so there are ways of kind of dialing down the volatility and staying within the theme, as well as pairing the themes, which I wrote about in my monthly, the idea of having both XLE and the clean energy, ICON, LIT, things of that nature, together in the portfolio. There is the opportunity to have XLF and ARC FinTech in the portfolio. And so you're balancing and you don't suffer the straight declines, which if you just have ARC itself, which to just touch on for a moment is clearly the poster child for this whole thing. Kathy Wood, and she's a veteran, so I know she understands the game, right? As soon as you think you're doing really well in this business that we're in, you know that the fall is coming. And so she's on every magazine cover, financial magazine cover the last 2 months, and boom, she's down 30% in 3 weeks. ARC, the main ARC vehicle, is down 31% in 3 weeks. And it looks like it's going right to its 200-day average, which it ended up today, a weekday, disappointing day at $110, $111. The 200-day moving average is $103. So it looks like it's going to definitely get there. And that's where, again, if you're looking to buy, and I do think people should be looking in the clean energy space, in the electric vehicle space, in the battery space, in the carbon space for opportunities. Carbon is something I'm increasingly interested in, and initiated a position in the model portfolio last week. There are credible expert opinions stating that carbon needs to price out at around $160 a ton. It's currently at $27. China is going to start to price carbon. US is going to be pricing carbon. we're going to have global carbon pricing in the next year, and there are very few ways to participate in the ETF space. So that's an area. So there are ways, and this is where I think, Roberto, having a guide, having people to work with you in these markets is very helpful. Not to say, of course, that it's going to be always correct or always right, by no means, but to say that within the themes and within the old versus the new, and within the world of a bear market and treasuries and a move outside of the United States for the first time in a decade, it helps to be with people and work with people who have an understanding of this environment. And so for me, I do think that I'd be more a buyer of clean energy today than of old energy. I'd rather be looking at where to buy things like ICLN, lit, cars, etc., than XLE, because XLE is going to correct. You couldn't break through 70 with the Saudi facilities being under attack. That tells me something.
No, of course, and I have just a point on clean energy, ICLN. Maybe what happened has to do with the way that ETFs are constructed, and to my surprise, someone sent me a list of ETFs where Tesla is a big part. So that and they're being the poster child of this long duration trade that helps affect the whole space. But I would like to hear where how are you playing the infrastructure and especially the carbon trade. So if you could mention a couple of the ETFs, and then we can of course later follow up on that, and I'll send it right into people.
Sure. Yeah, I think the infrastructure. Well, first of all, I'd say yes. Tesla is the stock. ARK is the family, ETF family that is the poster child. But again, and I'm not an expert on Tesla or on company-specific work. I do much more thematic and ETF-based work. Mm-hmm. But I would say that, again, the difference is that virtually every car market in the world is going to be focused on being majority electric vehicle in the next 5 years. So yeah, more people are going to be providing electric vehicles. There's going to be more competition for Tesla. But the case is that the vast majority of vehicles are going to be electric, and Tesla is the market leader. So at some point, there will be a bid. And part of the problem is that many of these things ran up so aggressively that even down 20 and 30%, people have gains in them. So I think that's part of the reason why the sell-off has been kind of so violent. You can be down 30% and still be up, 30 or 40% in your positions. Yeah. Therefore, people are still willing to sell. But and again, so that's a good segue into the carbon, because the instrument I'm using is KRBN. It's unique in that it works purely off of the price of carbon, the carbon trading price. And so it doesn't have the Teslas and the other things that you mentioned, because you're correct that many of these ETFs kind of hold a lot of the same type names. And that's exactly why I chose. There are several other low carbon ETFs, but that's exactly why I chose KRBN, was because it doesn't have any of those. It's priced purely off of the trading price for carbon. And then in the infrastructure space, the point I would mention is it's not simply the Biden climate and infrastructure plan that is going to be coming and will most likely be introduced in the next 30 to 45 days. So again, this is the Biden administration going big, going fast. It's going to be rolled out. Meetings have already been held between the president and various lawmakers. It will be rolled out shortly. It's going to be very big, as well it should be, because here's the other point. The American Association of Civil Engineers grades the U.S. infrastructure capacity on a 4-year basis, every 4 years. and they just did the latest one, just came out in the last couple of weeks, and the grade is a C-. So relative to where a infrastructure, roads, ports, bridges, tunnels, etc., relative to where it should be, the U.S. Association of Civil Engineers, so not non-political, expert point of view, C-. And amazingly, that's up from what the grade was in 2017 when it was a D. So there is a tremendous need for enhanced infrastructure in the United States. And we're seeing it with, the issues around logistics and deliveries and packages and things of this nature, ports, not able to accept ships, all sorts of issues. 5G, 5G broadband will be a part of this. So I expect it to be fairly well organized, again, because this is not a new thing. This need has been known for some time, and finally it looks like we're going to get something done on it. And so the vehicle that I've used is PAVE, P-A-V-E. It's 70% industrials, which I like, and it's also majority mid and small cap, which I also like, to get into that theme of mid and small cap, the size factor that we touched on earlier. We're moving from big cap domination to small mid cap opportunity sets. And so that's the vehicle that I've used to participate in infrastructure. And so as I work on positioning all this within the model portfolio delivery service, that's now become a pretty good chunk of the thematic exposure. Carbon and PAVE have become fairly significant.
No, and it's excellent that you mentioned this, because I believe I have told you that there are local brokers in Brazil in those structuring vehicles where people can invest in reais in some of these ETFs. So I was just on a call with one of them a couple of weeks ago, and there is a local vehicle for the ICLN. So it's always good to hear that, because this is this is something that it's opportunities for everybody in these teams. So now we can talk about rotation and the rotation trade, and elaborate more of that. And what I'd like to say is that if you look at a day like today and look at your screens, it's like rotation on steroids, because you have at the same time Nasdaq I think almost 2%. I didn't see how it closed. But and although it closed earlier, the DAX in Germany up 3.5%, which is I think that's the market which is mostly pro-cyclical. So should people get used to see more days like this? Of course today the gap was a bit extreme. And when you talk about non-US, how do you see Europe vis-a-vis Japan and or the rest of Asia?
Yeah, I've been a big fan of Europe. I've been laughed at on TV many times by folks when I talk about the bull case for Europe. But to me, Europe really has the opportunity to win the decade of the 2020s. And essentially, it's because it is integrating through its joint recovery fund and Green Deal, fiscal stimulus, and climate. And this is now going to be repeated in the US with the rescue plan, or not so much the rescue plan, but the climate and infrastructure plan. Fiscal spending and climate together. So you fix the issues on the climate side, and you provide good jobs, paying jobs on the other side, and you leverage the fact that you can borrow at very cheap rates, which means that ideally many of your projects should easily more than cover their cost of that you entail by borrowing to fund them. And so Europe, to me, the joint issuance of debt to fund the joint recovery fund is a brand new thing. For the first time really ever, Europe is issuing joint debt So that leads to, I expect, more joint taxation. And I think that joint taxation will include digital tax as well as climate and carbon taxing. So these are examples of the European integration process really starting to come together. And if you're able to have joint issuance and joint taxation, then you may lead to much more of a joint banking union, where you can start to have the banks start to trade. You have an M&A opportunity, big M&A opportunity in Europe in the financial sector. And these are the things that are all, then that supports the euro. If you are able to start to have a deeper fixed income market, that supports the reserve currency status of the euro. Right now, one of the problems with Europe is that we depend on the Bund, the German Bund market, to be kind of the European safe asset. The problem, of course, being that Germany really doesn't borrow all that much. So it's an infinitesimal sized market for a region that's 500 million people and 17-18 trillion dollar economy. So it needs to have a European-wide safe asset. And I think we're moving slowly but surely in that direction. And so to me, Europe's ability to spend, the challenge is that Europe is not moving fast enough, particularly around 2021, because the challenge is that most of the Joint Recovery Fund monies are not going to be provided until 2020, late 21, 22, and 23. The good news, therefore, is that Europe's medium-term profile looks pretty robust. The worrisome part is that the very near term, the next 6 months, is somewhat challenging because it doesn't have the same fiscal drive that you're seeing in the United States. The offset to that is visible in the manufacturing sector in Europe, where PMIs are very robust. And that's in part because Europe exports a lot, primarily to Asia and to China. And this, by the way, as a quick aside, is why it's a tripolar world, and why Europe is its own animal, Asia is its own animal, and the Americas are its own animal. And you see this playing out when President Biden and U.S. policymakers talk about Europe allying itself with the U.S. against China, and the pushback from the Europeans, in large part because China has become a more important export market than the United States for European companies. And so you really do have a tripolar world manifesting itself, and Europe, through this integration process, I believe has a chance to be very successful in the next decade, because it's going to be the positive surprise. Everyone knows about Asia. It's the consuming center. It's going to continue to be. People wonder about the Americas. I wonder what is the driving thesis to the hemisphere that we're all a part of. And Europe, I believe, is integrating. Brexit and President Trump were very powerful reminders to the European decision makers and policy makers that they need to act by themselves. And thus, the main term in Europe, which we've used in this call before, is strategic autonomy. The main term coming out of China is self-sufficiency, particularly around technology, because the U.S. has spent the last several years telling them they can't depend on the U.S. for their technology. So no surprise, they're going to make their own. And all this is kind of long-winded, and I apologize, but I think it's good for the audience to understand that when I talk about markets, it comes from a pretty deep reserve of thought and knowledge about where these regions are going, which again comes from the tripolar world and is an example of kind of differentiated thinking. So to finish up, Europe is primarily cyclical. The makeup of its market is primarily cyclical. The euro itself, according to the OECD, is 16% undervalued right now, 16% undervalued. The European banks, which I've talked about before, I continue to like them a lot, are very, very cheap, among the cheapest major banks in the world. I do think there's already domestic M&A in the financial sector in different countries in Europe and Italy and in Spain. I think there's potential for region-wide M&A in the coming years. And the last point I would make is that the Joint Recovery Fund and Green Deal is very favorable for the peripheral countries, namely Italy and Spain. The two biggest recipients of this money are going to be Italy and Spain. And so unlike in 08-09, when the response was really kind of divided the European Union, with Greece and others really problematic and potentially going to leave the Union, now, again, the policymakers have learned, and so the thrust of the Joint Recovery Fund and the Green Deal is to integrate further the periphery with the center, which helps the bond market, reduces risk of bond concerns. Like a couple of years ago, remember, the fear was that Italy was going to blow out versus Germany. And today, the German-Italian bond spread is as tight as it's been in many years. So to me, Europe has a lot going for it. I do think that they will get the supply issue of the vaccines figured out. Right now, the US and the UK, for example, have moved away from supply concerns to demand concerns, getting people to take the shot, as we touched on at the outset of the call. Europe is still in the supply issue, still trying to get the supplies that they need to inoculate their people. I believe they will get that. They will inoculate their people aggressively, and you will have a beneficial effect where that gap between the manufacturing PMI and the service PMI, which is very wide in Europe, starts to narrow. That's very bullish for the reopening trade, and that's the type of thing that I think will really play out in Europe, because the lockdowns in Europe have been much harsher than in the United States or in Asia. So the real reopening trade opportunity is Europe.
You know, those are great points. And being in Italy, I'd like to share a couple of things. And I was watching yesterday an interview with Enrico Letta, who was, Prime Minister of Italy in 2013 or 12. And a couple of interesting things were mentioning. And when you talk about populism, it's people don't appreciate, how much it's declining in Italy. I mean, of course, we hope this lasts, but a couple of examples, not only, Draghi, being prime minister, but, Lega, who was anti-European before, with the leadership of Salvini, they basically became Europeists, so, pro-Europe. So this was the biggest trending topic on Italy, on Twitter, a couple of weeks ago or a month ago, like Salvini being pro-European. And what Mr. Letta was talking about was even Lega joining the European Popular Party, which is, the center-right coalition in the European Parliament. And the other thing was, Giuseppe Conte, who was, a law professor, former prime minister, being appointed the leader of the Five-Star Movement. So, they kind of giving it a more, and taking that role from a former comedian. So I think those things, pointing to the right direction. And what I was going to ask, you talked about, the inoculations. Europe knows that they have messed up, and they, there was an issue with the rollout initially, and now, there's been some, finger pointing towards AstraZeneca, but they know they have to fix it. So Germany has said that they want to vaccinate 10 million people a week, from the end of March. Italy saying the same thing. So the question is, to what extent, this acceleration of vaccination, the reopening trade, can that offset the delay in the money coming from the European Union on the infrastructure plan?
Yeah, I think that's a great question, Roberto, and thanks for your thoughts and insights on the political environment. I agree completely. The populist movement in Europe is much less robust than it was a couple of years ago. And again, people need help and want the governments to help. And so the governments that understand that and act are going to be very popular. Again, like I said, the rescue plan in the United States had well over 70% approval rating. It's one of the most approved political acts in years in the United States. And that's going to pay dividends in 2022. And so to me, that's a real important point. I expect similar results in Europe as you just laid out, particularly in Italy. Draghi is a master of European politics. He also is going to have a tremendous amount of European money to spend to fix Italy. And if he's able to demonstrate success there, that will be a significant change in the political landscape in Italy and therefore in the European Union. And I do think, to get to your question, that the demonstrated capacity to inoculate citizens, again, to government help citizens in a way that only the government can. This is where we're at today. It's no longer an issue of like a company can help me more than the government or the internet can help me more than the government. No, dealing with COVID, dealing with climate requires government support. And those are differentiating points that people need to keep in mind. And so I do think you see it playing out. Look, everyone knows that Europe has been a disappointment in terms of its vaccination rollout, but yet the stock market is up. Why? It's telling you that, first of all, the manufacturing sector is red hot. Second of all, it's telling you that the lockdowns are the harshest in Europe. So when they ease, it's going to have the biggest upside. We never really had lockdowns like Europe has now in the United States. And so that gap, again, the gap to watch is the gap between the European manufacturing PMI and service PMI. It's about as wide as it's ever been. As that gap narrows, that has significant, JP Morgan had some great work over the weekend, shows the relationship between the service PMI and the reopening basket that they've created. And we can't, we don't have access to the basket, but we know what names are in it. We know what sectors you can participate.
Yeah.
And so that's the thing to watch. And so markets are discounting and moving aggressively. And they've seen the US go from 500,000 shots a day to 2.9 million. That's 6 times. In less than a month, we've gone from 500,000 to 2.9 million in a month or so. And so why can't Europe do the same once they have the vaccines? The public health system in Europe is much better than it is in the United States. So theoretically, you should be able to see that work and have big effect very quickly in the next couple of months.
No, that's great. So, we have 2.5 minutes left.
That's it.
I'd like to, I'd like.
The fastest hour on. It's the fastest hour on Zoom, Roberto.
Yeah, absolutely, and we need to do maybe a 2-hour session. But I would like to thank you again. Thank you, audience, and maybe give you 2 minutes to wrap up. And as we wrote, as you concluded our article, should people just keep calm and carry on?
I definitely think so. As I said before, markets are very choppy. You have to be very careful not to go from one side to the other. You don't want to be selling your new clean energy stuff today and buying XLE. That's not the trade. You don't want to be selling your treasury position if you still have one. You don't want to be selling it today, for sure. You don't want to. Another thing we didn't mention, but I wanted to mention, is the emerging market debt, EMLC and EMB. EMLC is as oversold as it's been in a very long time. So the dollar's had a nice bounce here. I don't expect it to go dramatically further. So again, you don't want to be selling your EMLC, your local currency EM debt, at this point. So pay attention to technicals. Understand the fundamentals, appreciate the difference between today and 2000, for example, within technology. Understand that the end of US tech dominance means opportunities abroad. Understand that the cyclical value rotation is still in its very early days, so you can be patient. You can wait for XLE to come in a little bit. The fact that you got the news over the weekend of an attack on the Saudi facilities and you couldn't break above $70 Doesn't mean that you can't get there next month. It does mean, though, that it's tired. The market's had a tremendous move. Things don't go, one way forever, either up or down. So stay disciplined, keep to your approach, look to Ohm Research and TPW Advisory for guidance, and keep calm and carry on.
Okay, thanks, Jay. It's been great, and I'm already looking forward to our next one in 2 weeks. And of course, if anything emerges, we'll be in touch, and we'll publish the musings on a weekly basis. And again, thanks very much. It's been great. And as Jay said, keep calm and carry on.
Thank you, everyone. Take care.
Take care. Bye-bye.